Hi there, I am Preeti Vachhani. You are watching Financial Management Series Session 2. If you have not seen the first session, do check out. The link is given in the description below. Before starting with today's session, I would first like to ask you a question. Are savings and investments same? Do type in the comment section below what do you think. Well, I'm sure you all will agree to this fact that savings and investments are not at all same. They are completely different. I'll explain this with the help of an example. Let's say you took the cash 1 lakh and you kept it inside a locker. Now this money is saved and not invested because you have literally kept it in a locker. So the money is really not going to grow and multiply while lying inside the locker. Instead, its value will keep on decreasing. As we all know this concept of inflation, in Hindi it is termed as mehengai. The purchasing power of your money decreases and the value of the goods that you need to buy, it increases over a period of time. So this is termed as inflation. So inflation eats your money. So if you keep your money idle without investing it, the value will definitely decrease. Your returns would be negative. Continuing with the same example, so if you kept your 1 lakh rupee in the locker 2 years back, okay, so now when you take out this 1 lakh, will this 1 lakh be able to purchase the product which was of 1 lakh 2 years ago? No, right? Because the cost of the product would increase over these 2 years. So it will increase, let's say, from 1 lakh to 1 lakh 5,000 or 1 lakh 10,000. Your money or your 1 lakh rupees does not have the power to buy the same product which you could have bought 2 years ago. This means that inflation has eaten up your money. The purchasing power of your 1 lakh has decreased. And this keeps on happening. In fact, if I talk about the current situation, the inflation is just rising, and we all know once the things restore to normal, the prices of a lot of commodities are going to shoot up because inflation is based on the supply-demand chain. People want to go out, they will start booking the tickets and they'll start booking the hotels. So what is going to happen? The demand is going to increase substantially. So here the supply is same, but if the demand is increasing, well, the prices will definitely shoot up. The prices of hotels or aviation definitely increase. So this is what inflation is all about. So inflation reduces the purchasing power of your money. So this brings us to a conclusion that we definitely need to park our funds somewhere. You cannot keep it in your savings account, right? We have understood that we need to invest. Now, a very important question arises, what should be the required rate of return? At what rate you need to invest? So always make sure that your rate of investment is higher than the rate of inflation. It should always be able to beat at least inflation, so that when you park your funds for a couple of years or 5 years, and when you get your money back along with the returns, at least your money does not lose its purchasing power. Just to beat inflation, yes, your returns should be at a rate equivalent to rate of inflation. But then here we are talking about generating wealth, which means that your rate of returns have to be more than the rate of inflation. Understand one thing, investment is the science of money making money. Okay, which means that when your money starts making money, that is what is called as an investment. I'll give you a simple example. You buy commodities, and under commodities you buy gold. Let's say you buy gold for 20,000 rupees. After a period of time, the prices of gold shoot up and you are able to sell the same amount of gold at, let's say, 22,000 rupees. So here what has happened, actually your 20,000 has helped you to make 2 more thousands. Okay, so this 2,000 is earned by your 20,000. You do not need to do anything. Your asset or your commodity will multiply your money. So here when you invested 20,000 and you sell it for 22,000, your returns are 2,000 for 20,000. Similarly, let's say you buy a property. Okay, so you buy land for 40 lakhs, and after a period of time it rises and it becomes 43 lakhs. And now when you sell your property, so the 3 lakhs is the return on your investment. So this is how your money grows. So money makes money. So your 40 lakhs have made 3 lakhs for you. So this is what investment is all about. So there are a lot of investment options available. You need to understand what all assets you need to include in your portfolio. So in my coming videos, I am going to talk about all the instruments in detail. Understand one thing, the kind of instrument you choose is based upon risk-return relationship. So you need to figure out what is the kind of risk that is associated with the kind of return that you are getting out of a particular investment. So if I talk about the investment options, let's say it's the savings account. Now we all know that if you keep your money in savings account, it is hardly going to beat inflation, because the percentage that you get in a particular saving account, it ranges from 3 to 4%. That's it. So this is at maximum that you get if you keep your money parked in savings account. And right now, if I talk about the inflation, it's around 6 to 7%, which means that your money is actually not growing, rather its value is decreasing. So you always need to have a check on the rate of inflation and the rate of return that your instrument is providing. Then what you can do is you can also park your funds in bank deposits, PPF, post office. Now I am telling you the sequence of the safest and lowest return. So if I talk about bank deposits, PPF, all of these have got lower to medium returns, but at the same time they are quite safe. I mean, your principal amount is intact. So in medium risk and medium return, you have debt related instruments. For example, debentures, bonds, debt mutual funds. So when your money is parked in debt instruments, the risk is low to medium and also the return is low to medium kind of. But at the same time, as you climb up the ladder of returns, well, your risk is also going to increase substantially. So if I talk about equity investments, so when you invest in shares, in stock market, futures and options and derivatives, so here your returns are very high, but then at the same time the risk is also very, very high. So you need to weigh both these parameters before investing and building your portfolio. So what is your risk appetite? What kind of age bracket do you fall in? Because risk appetite has got a lot to do with your age bracket, your income levels and a lot many parameters. So you need to have a look at what kind of risk you are ready to take and what are the returns that you want to generate. So what is the average minimum returns that you want to generate over a period of time? Okay, so you can have a look at your screen. A lot of products are there in front of you according to their risk return relationship. So I hope you got a fair idea about the concept of inflation, the different instruments based on risk return relationships. In my next session, I'm going to talk about these instruments in detail. Stay tuned for more. If you like this video, do hit the like button as it motivates me to create more of such videos. Do subscribe so that you never miss the updates on my channel. I'll see you soon with yet another powerful video. Till then, you take care of yourselves. Bye-bye.